And next paper will be presented by Nate Pattison. Nate?
Yes, thank you for having me. Thank you to the organizers for all the effort that went into this. So this is a paper on remote competition in small business loans. It's co-authored with Wenhua Di, who's also here in the middle. And we're still very much working on this paper and thinking about it, so I look forward to getting your input on it and conversations later. And these are our views and not necessarily the views of any of the institutions involved. So what motivated this paper is the central role that distance has played in small business lending in particular. So traditionally, the borrower and the lender have been located just a few miles from each other. This has largely been attributed to information in that it's easier to assess businesses' profitability or form relationships if you are physically closer, the borrower and lender are physically closer. But these distances have been expanding over the last 20 years. This attributed to improvements in information technology, underwriting technologies, and just the availability of the internet and online loans. And at an extreme of these increases in distances are remote lenders, which is our focus, and we're characterizing them just as banks with one or a few physical locations, but that lend nationally. So similar to the figure that was just presented in the last paper. And what we're interested in, what we're trying to get at, is the impact of this increase in remote lending on just the total supply of credit available, because it's not clear what will happen. Different models have different predictions. On the one hand, if remote lenders are using a different set of criteria, it's possible that they can identify profitable but underfinanced firms and extend them credit, thereby expanding the supply of loans in the market. But it's also possible that they can cream skim, take away the most profitable lenders, and that can harm the existing banks and also the borrowers that rely on those banks. So these are the trade-offs that we have in mind, and whether the market's growing or shrinking, you also want to know, even if it's growing, how much is it growing relative to causing substitution away from existing lenders? So these are the motivating questions, and we're going to look at them in a very specific setting, but a setting that lets us get, we think, very clean answers for this setting. So it's going to be in the context of SBA 7A loans. So these are government guaranteed loans given to small businesses that technically are not supposed to be able to get credit at reasonable terms from other banks without these guarantees. And it's a relatively small share of overall small business lending, so about $25 billion in 2017. We're going to be using data from 2001 on all SBA 7A loans that were given out. And the case study that we're looking at is the entry of Live Oak Bank, which is a large remote lender that started lending through the SBA program in 2007. And it's currently the largest in terms of dollars lent through the SBA 7A program. It's the largest, not just of remote lenders, but of all lenders, at least for fiscal year 2017. And to preview what we find, so we find that when this lender enters, that there are increases in overall lending, but perhaps more surprisingly, we find no evidence of declines in SBA lending from existing lenders, that it was a pure increase without substitution. And that raises the question, who are these new borrowers? So we find some evidence that there's a geographic explanation, that the borrowers are located slightly farther from physical branches of SBA lenders, but that's not the whole story, and we're still working on that part. Okay, so there are two figures really that motivate this paper from this SBA lending data. So this is, you can go to the paper for details, but this is our best measure of the distance between a borrower and the closest branch of the institution from which he or she borrowed. And the two features of this that we highlight, the first, I don't know if this works, is that for 2001, 2008, and 2017, this math here means a lot of the loans are still being given out very locally. So in 2017, 71% of borrowers borrowed from a bank or an institution that had a branch within 10 miles of where they were. The second feature that stands out is this growing mass over on the right, which is the increasing share of loans that are being given out at a distance of more than 100 miles between the institution and the borrower. So that's the rise of remote lending that we're interested in. The second figure that motivated this is just describing some of the characteristics of remote lenders. So on the horizontal axis, so each one of these circles represents about 10% of the SBA lenders. And the horizontal axis, as we move this way, it's the share of loans given to distant borrowers at least 100 miles away. And this vertical measure is how concentrated the banks are in giving loans to industries. So the majority of banks are down here, over 50%. They give very few loans out to distant borrowers, and they also lend across a very diverse set of industries. But as we move to the right and more remote lending increases at the bank, they tend to be more concentrated or specialized, giving loans to just a few industries. Okay. So a prominent example of this, and the one that we're studying, is Live Oak Bank, which is a remote lender that started in 2007. And it gives the majority of its loans out to just 6 industries. So that's where our experiment's going to be coming from. We're going to look at what happens in lending in these industries as Live Oak Bank enters them. So they gave a little under $2 billion in SBA 7A loans in 2017. So in context, that's just under 6% of all dollars lent. So they're quite large within this program. These are the industries. So of the over 800 5-digit NAICS codes receiving industries, almost all of their loans go to veterinarians, dentists, investment advice pharmacies, broilers, and funeral homes. And so we focus on the top 6 because they are older and they also have a larger market share in these, so we can hope to detect the effect of their entrance. The market share ranges from 12% to almost 60% of the post-entry loans, so taking a large share of these markets. And something that we, as a part of this research design, make use of is that they don't enter these all at once, but they enter them in a staggered way over time. So we're able to control for time effects that way by exploiting this staggered entry into these different industries. OK, so the question we want to answer is just what is the impact of Live Oak entering these industries and giving SBA loans on the total volume of loans being given out, and also the substitution away from existing lenders in these markets. But the challenge is that we only observe how many loans are given out when they entered. We don't know how many loans would have been given out if they had not entered. And as we saw from the first paper, this is a tumultuous time in lending. Industries are trending differently. The recession is happening. So how to deal with that problem? And what our strategy is to find similar industries that they did not enter and kind of do an industry-to-industry comparison. So we have the 6 industries that Live Oak entered and several hundred industries that they did not. And we use a data-driven method called synthetic control to select industries that they did not enter, but that look very similar and were trending similarly to the industries that they did enter during the period before entry. And this combination of these control industries is going to be our measure of how many loans there would have been if Live Oak did not enter. Okay, so this is the first set of results. So what these graphs show, we were only able to find a good, similar-looking group of industries for 4 of the 6. So those are the ones that we focus on. And the graph shows on the vertical axis the total number of loans given. On the horizontal axis, that's the year. The vertical red line in each shows the date that Live Oak started giving out loans. And what the blue line and the red line show are how many loans were actually given out in blue versus our measure of how many loans would have been given out in these industries absent entry by this remote lender. So we see across the board that as this remote lender enters, there's sharp increases in the number of loans actually given out relative to this construct of how many loans would have been given out based on similar-looking industries. And you see that if you look at just the pre-periods, the fact that they're all very, very close, that means that we're matching industries very well beforehand. So we're doing a good job of picking industries that look similar beforehand, and then they break apart at the time of entry. So this suggests that lending is increasing, but it's still possible that there's a lot of substitution from existing lenders going on. So that's what we look at next, and we're also able to construct an estimate of how many loans we would expect to see if there were 0 substitution away from existing lenders. That's what we plot with these black lines. And so for these 4 markets with Live Oak, we see that the blue lines, the actual number of loans, are right on top of for 3, or even slightly above with that one, though probably not statistically significantly different. What this means is that the number of loans we actually see is consistent with 0 substitution in these markets from existing lenders. So the total SBA loans in these industries are growing, and they're growing by the amount that you would expect if they were not causing any substitution away from existing SBA lenders. So that raises the question, where are these new borrowers coming from? And we're working on this, but the first explanation that we've looked at is, are they coming from areas that have less access through traditional banks to this SBA program? There's existing evidence that access to the program depends on proximity to a physical branch of a bank that specializes in SBA lending and has paid the fixed cost of getting acquainted to it. And we do find some role for that. Borrowers in these industries who borrow from remote banks are tend to be located a little bit farther from physical branches of lenders specializing in SBA loans. And we also find that they're located in counties where historically, before these remote banks, people were receiving fewer SBA loans per capita historically. But this is just a partial explanation. There are still many borrowers from these banks located right next to traditional banks offering SBA loans. So to summarize, what we do here, we do a case study of a large remote lender entering into specific industries. And what we find from this is that there are increases in total SBA loans given to these industries, and the size of the increase is consistent with no substitution away from existing lenders. A partial explanation we find is that they're lending to borrowers located farther away, and that may be why they were not borrowing through this program before, but it's only a partial explanation. It doesn't account for a lot of it. A caveat that we have is that all we're able to observe are SBA loans, so we can't, using that, differentiate between growth in total credit versus growth in just the SBA market. Maybe these borrowers would have gotten loans outside of the program and they're being brought into the program. There are some institutional features that may limit that, but I think I could learn more from you as to how much that applies. As for implications, so the most direct implications are on the SBA program here. These remote lenders like this are expanding the program and also potentially changing the composition of industries receiving loans as they specialize in certain industries and lend in large amounts to them. And then we present some evidence that they're expanding access to this program geographically in part. Finished a little early, but I'll stop there. Thanks.
Thanks, Nate.